Right friends, welcome back to Banking Awareness Current Affairs Q&A discussion. Look at the first one. Normally trading takes place in secondary market. All of you are familiar with the primary market, the secondary market. When I am purchasing directly for the first time, that is primary market. Secondary market means when you are purchasing from me, it is a secondary market. So please differentiate between primary market and secondary market, and which of the following is the exception? Bonds are available in the secondary market. At the same time, masala bonds, they are also tradable. Then shares, they are tradable, but bank fixed deposits, they are not tradable. Please understand, bank fixed deposits are not tradable. Which of the following is not fixed income security? You see, what is the meaning of fixed income security? Fixed income security means you will get regular income, maybe once in 3 months, once in 6 months, once in 12 months, you will get regular interest. And sometimes you come across various terms like yield, sometimes you come across interest rate, sometimes coupon rate, whatever way you call it, these are examples of fixed income securities. So here government securities will have a particular interest rate or coupon rate. When you are purchasing in the secondary market, that coupon rate becomes yield. Please understand the interest rates, two terms used. One is coupon rate, that is the initial interest rate announced. Then when you are purchasing in the secondary market, then it becomes yield. Then bonds will have specific interest rate. Commercial paper will have fixed interest rate. So whenever you have interest rate, that is example of fixed income securities. So if someone is talking about fixed income securities in economic parlance, please don't forget bonds, debentures, government securities, treasury bills. At the same time, commercial paper, these are all examples of fixed income securities, whereas shares are not fixed income securities. So shares are not example of fixed income securities. If a wealthy businessman has got rupees 100 crores of assets and he would like them to be managed by a professional agency, an industrialist is there, he is having 100 crores of property, he does not have time to manage them. So which of the following is the appropriate answer to solve this problem? Here the appropriate answer is portfolio management services. Please understand the difference between investment banking, merchant banking, portfolio management services, stockbroker. Stockbroker means he will act as per your instructions. You want him to invest in some particular share, he will invest. So stockbroker will invest as per your instructions. Portfolio management services are basically to manage the wealth of the high net worth individuals. Sometimes you come across HNIs also. HNIs means high net worth individuals, and to manage their wealth portfolio, this portfolio management services are intended. And when you look at investment banking and merchant banking, yesterday I told you investment banking and merchant banking are invariably interchangeably used in our country, and the basic purpose of investment banking and merchant banking is to look at how to raise money for companies. When companies want to raise money either through shares or debentures, how to raise money. So that is the main focus of investment banking and merchant banking. At the same time, they will look at the other aspects like mergers and acquisitions also. So these type of terminology you should be highly conversant. That will be useful in your English passages also. accounts with credit limit of dash are known as small borrower accounts. Please understand, accounts up to rupees 2 lakh are known as, in the banking parlance, small borrower accounts or SBAs. And here another important point is, sometimes you come across microcredit. Microcredit means credit up to rupees 1 lakh is coming under microcredit. And at the same time, investments in the stock markets up to rupees 2 lakh are known as retail investors. So, this terminology please do not forget. P2P lending is an example of nowadays crowdsourcing, that is the one word which we come across. Crowdsourcing means through online. Normally you have some project, so crowdsourcing means people will contribute for that. That is crowdsourcing. P2P lending means peer-to-peer lending, that takes place normally through online channels. And here, if I am in need of money, I will put up the requirement, and if you have money and faith on me, you will give me money. So, this type of arrangement of P2P is example of unsecured finance. So, please understand, P2P is unsecured finance and it is not regulated by Reserve Bank of India. So, these terms are the recent origins. So, please understand, P2P lending, at the same time do not forget crowdsourcing, and here unsecured finance. Several times you come across this word. Unsecured finance is basically the term where, when I am giving a loan to you, if you are not paying me back, I cannot do anything. Then, which of the following tracks the FDI flows or investment flows through the countries? This foreign direct investment flows. At the same time, investments from foreign countries are tracked by United Nations Conference on Trade and Development, or UNCTAD. United Nations Conference on Trade and Development, or UNCTAD. Indian economy can be taken as an example of, Indian economy is taken as an example of mixed economy. Please understand, what is the meaning of mixed economy? Mixed economy is basically coexistence of public sector as well as private sector. Here you see BHEL, NTPC, BSNL, Coal India Limited, these are in the public sector, they are there. At the same time, private sector like Tata Consultancy Services, Reliance Industries, Mahindra and Mahindra. So, the coexistence of both is known as mixed economy, and it is a combination of features of socialist economy and capitalist economy, right. And prior to the new economic policy of 1991, we have mixed economy, but with a socialist bias. Now, after 1991, please understand, our economy is still mixed economy, but with capitalist bias because of globalization and because of opening up more and more sectors for private participation, or you can say reducing the protectionist barriers subsequent to 1991 new economic policy. The right for an insurer to legally pursue a third party that caused an insurance loss to the insured is subrogation. This is the term in insurance. So, this is a subrogation. This invocation I will explain you in the next class. Default, all of you are familiar, and indemnity also I will explain in the coming classes with examples. So, right for an insurer, insurer means like organization like LIC is insurer. Insured means maybe the person whoever is insured. So, whenever any damage is there, then third party, when somebody is going in the car, if third party car caused damage, under those circumstances legally right will be there to sue the third party, that is known as a subrogation. Then which of the following can be considered as less risky from bankers' perspective? Banks, while granting loans, they look at the risk of particular type of loan. Wherever risk is less, interest rate will be less. Wherever risk is more, interest rate will be more. Here from banker's perspective, the less risky loan is house loan. Here you see vehicle loan, the risk involved may be more than the house loans. House loans means bank is giving loan and your house will be there, you cannot go away. It is a fixed property attached to the land. So, whenever any fixed property is attached to the land, then the risk will not be there. Then personal loans, and please understand, these personal loans and credit card advances are examples of unsecured loans, because there will not be any collateral security. So, please understand, the loans which will have security or collateral security like house loans, mortgage loans, they are having collateral security. Corporate loans sometimes may have collateral security. So, when collateral security is there, that is safe from banker's perspective. But when collateral security is not there, then it is unsecured loan. That means I have taken personal loan, I am not paying back. Banks cannot do anything normally. Then credit card advances, I used up to my limit of 1 lakh, then I am not paying back, then banks cannot do anything. So, these are called unsecured loans, and unsecured loans are highly risky from banker's perspective. That is why the interest for house loans is 9%, interest for personal loans is 15%, interest for credit card advances may be 24% or 36%. When the risk profile increases, then interest rate will increase. When the loan is unsecured, interest rate will be high. When the loan is secured, interest rate will be less. So, this is fundamental point in the banking system, please understand. Which of the following cannot come under the category of uncertain loans from banker's perspective? Uncertain loans. Uncertain loans means, basically please understand, the limit will be given. You can take or you can use up to the limit. You may use, you may not use, bank may not know. Suppose in your credit card, the limit is 50,000 rupees. In one particular month, you may use up to 50,000. In the second month, you may use 0. So, uncertain loans from the banker's perspective are the loans where a limit is given. You can take or you can access loan up to certain limit. So, they are uncertain loans from banker's perspective. So, cash credit is uncertain because limit is given 5 lakhs and I may use it, I may not use it. Then overdraft facility, that is also uncertain loan. Then credit card advance, that is also uncertain loan. So, from the banker's perspective, uncertain loans are cash credit, overdraft facility, credit card advance, whereas gold loans are certain loans. When I am pledging the gold, I can pledge my gold and I can take loan. My gold is with bank and they are giving me loan, that is pledge. Please differentiate between pledge, at the same time mortgage, at the same time hypothecation. So, there is difference between pledge, mortgage and hypothecation. Please listen to my banking lectures, I explained clearly with pictures. So, here which of the following cannot come under the category of uncertain loans? Gold loans is certain loans, uncertain loans. So, please understand in banking perspective, which of the following loans will have maximum interest? Such type of questions you can expect. Which of the following is an example of unsecured loan? Personal loans, credit card advances or unsecured loans. At the same time, uncertain loans, go here, overdraft facility, cash credit, credit card advance, these are uncertain loans, whereas gold loan or other term loans, they are not uncertain, right. Looking to the next one, the funding given by the government for public-private partnership projects when they are not commercially viable is known as viability gap funding. Here you see, when an expressway is to be constructed or when highway is to be constructed in Manipur, Mizoram, Nagaland, Arunachal Pradesh, there few people will travel, but still it is required from strategic considerations, and under such circumstances the developer will incur losses, so that losses will be paid by the government, that is known as viability gap funding. This term is very important, viability gap funding. And when an expressway is to be built between Bombay and Ahmedabad, let us take, then number of vehicles will be more, so the developer will get profits. Under those circumstances, developer will pay to the government, that is known as premium. So, please understand between premium and viability gap funding, these terms are important in public private partnership projects. Which of the following is an example for unsecured line of credit? Here two words are involved. Unsecured is one word, line of credit is another word. You should have clear idea about what is meant by unsecured, what is meant by line of credit. Unsecured means there will not be any collateral security. Here personal loan will not have any collateral security. Credit card advances, you will not have any collateral security. House loan, definitely it has got collateral security. Corporate term loans, sometimes they may not have collateral security, we do not know. But here second word is very important. Unsecured means here there is no collateral security. Second word is line of credit. Line of credit means, please understand carefully, the limit is given. You can utilize up to what extent you want. So, here credit card advances is the right answer. Here that is example of unsecured loan because no security is there as collateral. Next one is line of credit. Line of credit means limit is given. Sometimes you talk about line of credit in various newspapers. So, line of credit means that is the limit up to which they can access. That is example of credit card, right. So, here the answer is credit card advances. High yield debt instruments, these are high yield for which the money can be used in case of a catastrophe like hurricane or earthquake is known as cat bonds, catastrophe bonds. There the interest will be very high, but if something happens, then your money, part of your money will also go away. If nothing happens, you will get back your money after the period. So, these high yield debt instrument, debt, whenever somebody is talking about debt, debt means nothing but loan or the instrument where the relation is lender and borrower, and yield, high yield means high interest rate. So, high yield debt instruments for which the money can be used in case of catastrophe such as hurricane or earthquake are known as catastrophe bonds. Which of the following is an example for expansionist fiscal policy? Expansionist monetary policy, first let us understand. Expansionist monetary policy is nothing but more money will come into circulation. What are the ways of expansionist monetary policy? The first one is when repo rate is reduced, otherwise when CRR is reduced, otherwise when SLR is reduced, otherwise through open market operations when bonds are purchased from the market by the central bank, or otherwise helicopter money when government is printing notes for demonetizing the debt, for reducing the debt by printing notes is helicopter money. So, under these circumstances, example is expansionist monetary policy, money circulation will increase. And the question here is expansionist fiscal policy. Expansionist fiscal policy is more money in circulation again, but here it talks about taxation or more expenditure. So, when taxes are reduced, what happens? I will have more money to spend. So, when taxes are reduced, I will have more money to spend. So, that is why more money or more public, more expenditure by the people will come. So, reducing the taxes is an example of expansionist fiscal policy. At the same time, when government's expenditure is increased, that is also example of expansionist fiscal policy. So, please understand fiscal policy and monetary policy, these are quite often asked in examinations. Which of the following cannot be categorized as retail electronic payment mechanism? RTGS is not retail. Here the minimum is 2 lakhs, beyond 2 lakhs only we send. That is not example of retail payments. Retail payments examples are NEFT is example of retail payment, IMPS is example of retail payment, debit cards are examples of retail payments, but RTGS is not a retail electronic payment mechanism. Credit hypothecation, cash credit hypothecation is for cash credit. Probably you might have gone through my banking awareness lectures. Cash credit is, suppose I manufactured 1000 computers. I manufactured 1000 computers. Against the hypothecation of these 1000 computers, I will say whenever I sell these computers, I will pay you back. So, against the hypothecation of these computers, because I manufactured, I created value, against the value created by me, when bank is offering me some sort of a cash credit facility, that is cash credit hypothecation. So, cash credit hypothecation is against my manufactured products, if bank is offering the limit, that is cash credit. So, cash credit hypothecation is basically for working capital requirements. Any company will have two types, please understand. One is capital, second one is working capital. Capital means for purchasing various assets like machinery, establishing office, establishing equipments, that is capital expenditure. Once the company is established, then it requires working capital for running it on day-to-day basis, and this cash credit hypothecation is example for working capital requirements. BCSBI, Banking Codes and Standards Board of India, is society. It is registered as society. It is established based on SS Tarapur Committee recommendations, and balance in which of the following account is not fully repatriable. Please understand, NRO account cannot be repatriated back. That means when a person left to America, he can have 3 accounts, he can have 3 types of accounts, NRO account, NRE account, FCNR account. Whenever he want, he can take back full money from NRE account and FCNR account, but he cannot take full money back, only partly he can take back money from NRO account. This in banking awareness I explained clearly. The risk caused by the failure of a bank collapsed, that is severe enough to cause instability in the financial system. Let us assume SBI collapsed. When SBI collapses, what happens? Several other industries will collapse, and whatever the organizations which have links with SBI may also collapse. So, when a failure in the economic system leads to chain reaction, what you call, this is chain reaction. When that happens, this is known as a systemic risk. Then here operational risk I will explain subsequently. Credit risk means whenever you are giving some loan to somebody, then it will have credit risk. So, you should have clear idea about various types of risks like systemic risk, market risk. Because of changes in various market conditions, market overall is at risk, that is market risk. I will explain you with some question next week. So, systemic risk is when one failure causes some chain reaction, it is systemic risk. Then credit risk, operational risk. Operational risk, next example you see, when a van is carrying money to load in a rural ATM. When a van is carrying money to load in a rural ATM, some theft occurred. This is an example of when some theft occurs, that is an example of operational risk. Because of internal problems in the banking, if some risk happens, that is operational risk. If banks are giving loans to longer tenures, then it may lead to, you see, banks maximum fixed deposit tenure is 10 years, but banks are giving loans up to 40 years, let us assume. Bank loan is up to 40 years, whereas its deposits maximum period is 10 years. Then what will happen? Asset liability mismatch will happen. Assets means loans in the banking system. Liabilities means deposits in the banking system. So, if banks are giving loans for longer tenures, it may lead to asset liability mismatch. Then, name the largest global development finance institution. Basically, it is intended for development finance, arrange finance for the needs like infrastructure, for the development of the countries. So, the largest global development finance institution is World Bank Group's IFC. Then the next one is GST Council. All of you are clear, it is headed by the Finance Minister. GST Council is a constitutional body, and there the center is 1/3 weightage, states is 2/3 weightage. It is headed by the Finance Minister. So, these things please do not forget. Look at the last question, which of the following will not have a maturity? Normally, bonds will have maturity. 10 years, 5 years, 15 years, and there are one type of financial instruments which will not have a maturity. They are known as perpetual bonds. So, perpetual bonds are the bonds which do not have a maturity. Right friends, with this let us conclude today's discussion. Have a nice day. Thank you.